personal finance decisions. And so they talk about a few different topics in here. One is traditional and Roth IRAs. And then we'll talk about consumer loans. And then mortgages with points and adjustable rate mortgages. Okay, so first, retirement accounts. So it says the benefit of setting up an IRA as opposed to putting money in an ordinary savings account is that the interest earned on an IRA while you're still working is not subject to taxes. But if you fill out your taxes and you have a savings account with a lot of money in it and you earn interest, you have to claim that as income, and so you're taxed on it. So it says, but if you withdraw money before you turn 59 and a half, I'm not exactly sure why they chose that age, you will be assessed a penalty. So it's kind of like an early withdrawal fee, and it can be pretty hefty. So our book talks about two types of IRAs, traditional and Roth. So it says for a traditional IRA, your contributions are tax deductible. So the money that you put into the account, you can get use as a deduction for your taxes. And the interest earned is not taxed until you start making withdrawals. So you'll be earning interest while you're working, but you don't have to claim that interest as income until you start taking money out, so usually age 60 or later. But the maximum allowable contribution for an IRA was $5,000. So that's not really that much per year. Okay. So it says when you start making withdrawals, you're taxed both on the withdrawals because it's like you're getting payments, that's like income, and you're earning interest at the same time. So you're getting taxed on both the money that you take out and the interest earned by the money that stays in. But so you don't get taxed on it though until you retire. So it's tax-free for a long time. It says in a Roth IRA, contributions are not tax deductible. So even if you take money out of your check and put it in a Roth IRA, you still have to count that as income. But when you start taking your money out, you're not taxed. Okay, so you never are taxed on the interest. So it's either you're taxed while you're working or you're taxed while in your retirement. So it's one or the other. Okay, so marginal tax bracket is one of the terms that is used in regard to IRAs. So it says if you're in a P% marginal tax bracket, and your tax bracket is based on your income, and it's in tax tables, like the 1040, the booklet is full of tax tables. So it says that means for each additional dollar you earn, you pay an addition, that should say an additional P, and I don't know why that symbol didn't show up, P cents per dollar in taxes. Okay, so problem 5 from page 513 says if you're 18 years old, deposit $5,000 each year into a traditional IRA for 52 years at 6% interest compounded annually and retire at 70, how much money will be in the account upon retirement? Okay, so first of all, interest is just compounded annually, so that's just one time a year, and you're doing it for 52 years. Okay, your interest is 6%. PV, so remember PV means one initial, like a one-time payment. Is that the case here? We'll assume that at the end of your 18th year, so at the end of every year. Well, they tell us 52 years, so we know how many periods. They say that we're doing it for 52 years, so we're going to assume 52 payments. Well, okay, so is this 5,000? So think of, we have these two things to worry about, PV and payment. So the $5,000 though would be a what? Because that's each year. So a PV would be something separate from your initial, I see what your question is now, yeah. No, it would be like, and you make an initial one-time deposit. They would be very like specific and yeah, about that. So our payment is, so they're not making one lump sum. And I'm going to make the payment, I'm going to call it negative. And it's fine if you call it positive, it would just call it your future value negative. But so I'll think of, I'm taking this money away from myself right now, I'll get it later. So that's why future value will be positive. Future value is what we're trying to find. So we'll enter 0 and do the alpha solve there. But it's just once a year. Okay. So 1,641,407.11. So it says, suppose now that at age 70, you are in the 25% marginal tax bracket and you withdraw all the money from the account. How much will you have left after taxes? So this is, it's like extra income. And so if you're in the 25% tax bracket, then you pay 25% of that in taxes, right? So we'd have 75% left, right? So 1,641,407.11 times 0.75. So you'd still have 1,231,55.33 left. So let's see. So here is the the Roth IRA. So traditional, you got to put it in. It wasn't taxed until you made withdrawals. And here, this person made a one-time withdrawal. And probably the reason that you would make a one-time withdrawal rather than several withdrawals is you're being taxed so highly on this 25%. You would probably take that. Once you retire, you would take the money totally out of the IRA and put it in something else that you wouldn't be taxed on so highly. And, some stocks will, depending on the market, you can expect a better return than 6%. So. Okay, so it says, suppose that instead of depositing into a traditional IRA, you deposited $5,000 each year into a Roth IRA, so we're still going to assume the 25% marginal tax bracket. And so that $5,000 is still taxed, okay? So that you want to think of, I don't really get to keep all of that $5,000 every time. We only get to keep 75% of it. So we would do 5,000 times 0.75. So instead, what goes into the account, the part that's not taxed, is $3,750. So that's going to be our payment. And then N is still, I'm going to assume that all of the other things are the same. It's still 52 payments, still 6%, PV 0, and now we want to figure out what the future value is, and we're still assuming annually. Oops. So the only thing I need to change is the payment to be $3,750. So if we go to future value and hit alpha enter, notice that we get the exact same amount. Okay, I mean, it's set up that way. It's just this time, if that 1,231,055.33, you can take it all out at one time, and it's not going to get taxed this time when you take it out, because you've been taxed on it the whole time you were earning money. Okay, so Consumer Loans and Truth in Lending Act. So it says in the group work, the problem dealing with 3-year CDs had a column for rate, CM, and a column for APY. So this was the 3-year CDs. So here was the rate, And then CM meant for how often it was compounded. So here, the first 4 I showed were all daily. Not all of them on this web page were daily, but these were. So the rate, so it says for each, this means the rate on this CD was 2.57% compounded daily, and then this was the effective rate, the 2.6. So remember, effective rate means if you just got interest one time a year, what would the rate have to be so that it would turn out to be the same as the compounding? So this says APY, and the Truth in Lending talks about APR. APY means annual percent yield, and they call it APY with CDs because you're earning this money. So it's yielding that money to you, you get it. But with loans, you're paying that money. So that's why they just use APY, APR, really both mean effective rate. It's just that if you're earning it, they call it yield. If you're being charged it, they call it a rate. So it says the most widely used method for determining finance charges on consumer loans is the add-on method. With the add-on method, the stated interest rate is applied at the beginning of the loan to determine the amount of interest paid. Then the regular payments are determined by dividing by the number of compounding periods. So let's see if I have one on here. So it says use the add-on method to determine the monthly payment. So a $6,000 loan at 7% stated interest rate for 1 year. So what they're doing is they're at the very beginning taking $6,000 and automatically charging you 7% interest, and they say you're going to have to pay that. So let's see. So that's what, 420? Yeah. So that's how much interest you have to pay. So the total to be repaid is $6,420. Then they're just going to divide the total, by the number of payments. So it's for 1 year. So we would just divide that by 12. So the payments will be $6,420 divided by 12. So 535. So the APR, so we want to find if it was the, let's see. Set a method to determine the monthly payment. Okay, so let's see. If we wanted to say, but this was just monthly payment, I'm sorry, okay. So if it was a monthly payment, then that would be, we would think of it as being compounded 12 times. And it's 1 year, so 12 periods. The APR, that's what we're trying to find. PV, their loan amount was $6,000. And their payments were $535. Future value 0. And remember, these have to have opposite signs, the PV and the payment. No, as long as they have different signs. If you made your PV positive, your payments negative, that's fine. Okay, so 12, negative 6,000. 535, 0, 12. And then go back up to I and hit alpha solve. So 12.68% APY. Oops, not dollars. Or APR, sorry. Okay, so 16 says give the add-on interest rate for a $5,000 loan for 1 year at 6% APR with a monthly payment of $430.33. So we don't really care about the APR so much. What we know is there are going to be 12 payments of this amount. So I'm just going to multiply that by 12. So you end up paying, so the total paid is $5,163.96. So how much interest did you pay? Yeah, $163.96. If your loan was for $5,000, everything over $5,000 was interest. And we just need to figure out what percent that is of the loan amount. So we'll just divide this by 5,000 and change to a percent. So it'd be 3.28% is the add-on interest rate. So these loans are, I mean, a little bit misleading. So that's why they have that Truth in Lending Act, because when they say 7%, that doesn't sound bad. But if you think 12.7% compounded monthly, that's a pretty high rate. So that's why they really are supposed to publish both. And so now you almost never see the add-on interest rate. You almost always see, I mean, like when you get credit card applications, they give you the compounding rate. Okay, so mortgages with discount points. So it says home mortgages have a stated annual interest rate called the contract rate. However, some loans also carry points or discount points. So it says points can decrease your interest rate and are determined by a one-time payment made at the same time as your down payment. A point is equivalent to 1% of the purchase price. So what happens is if you increase your down payment, your interest rate goes down. So it says if a house costs $200,000, a mortgage with 2 points would require a $4,000 addition to the negotiated down payment. The loan amount is still called you still use $200,000 as your loan amount. This $4,000 is not used to reduce your principal. It's used to reduce your interest rate. So this is kind of like, I'm going to pay off some of my interest up front. So your loan, yeah. So we'll see how it works here. So it says when determining the APR for a mortgage with points, subtract the initial points payment from the loan amount and then use the TVM solver to find the rate. So let's look at an example. So problem 30 says the APR for a 25-year mortgage for $250,000 at 9% interest compounded monthly and 4 discount points is. So I don't know that we.
How much does the points affect?
I'm thinking that they said this is their lower interest rate.
Yeah.
So I think what we're being asked to find is if we didn't pay any points, what was the offered interest rate? So 25-year mortgage, so M would be 25 times 12. The interest rate is what we're trying to find. The PV, so this is if we didn't, use any points. Oops. Oh, I think we're going to have to do, we're going to have to deal with this first to figure out what the payment is, right? And then see what it would have been otherwise. So future value would be 0, P per Y, C per Y, 12. So 25 times, 25 times 12. So here we'll actually use 9% so we can find out what that payment would have been. So our payment, that's what we're trying to find. Future value 0, so I can just hit alpha solve here. Okay, I'm just going to use 2098. Okay, so this, I think I should have put a little more explanation in that first paragraph. Now, when they give you the rate, so, I mean, if you have that extra money, you could have used it for points to reduce your interest rate. Or, I mean, if you just have that money available, you can also use it as your down payment. So if it's without points, you would take that money and use it to reduce your loan amount. So I have to figure out how much did they pay then if it was 4 points. 4 points means 4%. So I think that's 10,000. 250 times 0.04. Yeah, that's $10,000. So the PV we're going to change to be 240. We're going to assume that it's like the traditional IRA, Roth IRA. The only thing that changes is the rate. I'm going to assume same payment. And now the interest rate is what we're trying to find. Okay, so still 300, interest rate, that's what we need to find. Well, yeah, I mean, if we have two unknowns, there's no way we can do it, right? You can't solve an equation with two unknowns. So that's the only thing really we have to do is to assume the same payment. I mean, it's a valid question, but yeah, we can't do it if we didn't know either of those. So let's hit alpha solve. What do you think should be the relation to this interest rate? It should be lower or higher? Should be higher, right? Because the points were used to lower the interest rate. So alpha solve. Yeah, so like 9.51% interest. Okay, so interest only and adjustable rate mortgages. So it says these are, for the most part, the types of loans that led to the mortgage problems / crisis in 2008 and 2009. So it says with an interest only mortgage, the monthly payment for a certain number of years, usually 5 or 10, and usually 5. 10 is kind of a long time to make interest only payments. So all you do is pay down the interest. So you just pay exactly the amount of interest you earn. You never reduce your balance. So it says we can use the simple interest formula with T, the time is 1/12, because it would just be, the same thing would happen every month. Your interest rate is the same. You're going to earn the same amount of interest every month. So it says in these types of mortgages, the principal is not reduced at all during the initial period because all you're doing is paying the interest. So if your loan was for $250,000, your outstanding balance at the end of those 5 or 10 years is still $250,000. It is possible to earn equity, though, because if the value of the house increases, you could sell it for more than $250,000, and so you could still make money off of doing that. So it says if you took out a 30-year mortgage for $250,000 at 6% interest compounded monthly, for which the first 10 years consisted of interest-only payments, then so since it was a 30-year mortgage, normally in a 30-year mortgage, you would be paying off the balance over 30 years. But if it has part of it is an interest-only phase, then you have a shorter amount of time to pay off the full balance. So your payments are going to be quite a bit bigger. So here it says, figure out the payment of the previously described mortgage for the first 10 years and then the last 20 years. Okay, so for the first 10 years, then you're just paying the interest earned in 1 month. So I equals PRT. And I is what we're trying to find. That's what our payment is going to be, the interest earned. Principal is $250,000. The rate is 6%. And the time is 1/12. So $1,250. So the first 10 years, that's your mortgage payment. For the last 20 years, so now for the last 20 years, the number of compounding periods is 20 times 12. Your interest rate is still 6%, but your balance is what it was at the beginning. So your balance is still, or your PV is $250,000. Payment is what we're trying to find. Future value 0 because we want it paid off at the end, and 12 per year.
Why do they have to keep paying 6%? You already pay all the interest off the first 10 years.
No, you only pay, you earn interest the whole 30 years. Every month you earn $1,250 of interest.
Basically, just keeping
Yeah. Yeah, so like if you have a credit card payment, you know, you have like some of it you're being charged interest. If you only paid off interest, as soon as you start paying off your balance, you're still earning interest, right? You earn interest all the time. You're earning interest every single month. As long as you have a balance, you're earning interest. You didn't pay off all of the interest. You just paid off the interest you earned in the first 10 years. Because, okay, so if you're straight out of college and you don't have a lot of money and you find a really nice house, you think, oh, I can afford $1,250 a month, you know? And then in 10 years, I'm going to have a good job so I can afford bigger payments. Well, that's the problem, is it didn't. That's why we're having such a problem with the housing market, is because people thought they were going to be able to afford it, and then they can't. So, okay, so apps. Okay, so 20 times 12, 6, negative 250,000. Okay, so payment, we can hit alpha solve. So 1791. So it went up over $500 a month. So, which may not seem so bad, but depending on, the thing is, people say, okay, my job is going to be better, but there's a good possibility that in those 5 or 10 years, they maybe added kids to their family or something, so then their, you know, monthly expenses have gone up quite a lot too. So it's hard to predict what's going to happen. Oh, then it says, suppose you had taken out a traditional 30-year mortgage. What was the mortgage payment in that case? So the only thing we need to change is the N would be 360 and go down to payment and hit alpha solve. So if you had taken out a traditional mortgage for 30 years, your payment would have been about $1,500 for the whole time. And notice it's about halfway between those. Okay. Okay, adjustable, we're just going to quick finish this. So adjustable rate mortgages, ARMs, are generally for a shorter term. 15 years is common, but not always. Some home buyers will take out 2 mortgages when they buy a house. They'll take out a traditional mortgage and an ARM. So it says, the reason people might take out 2 mortgages is because if you make a large down payment, so at least 20% of the assessed value of the home, or if you don't make that large a payment, you have to buy what's called mortgage insurance. And that can be, you know, over $100 a month. And that's added to your mortgage payment, so you have to pay that every month until you've earned 20% equity in your home. Or they might just say, okay, you have to show that you can make these payments and then we'll let you go. So the mortgage insurance is to protect the mortgage company. If you default on your loan, then they at least have some money that they can use to get the house ready to sell. So it says if you're a first-time home buyer, it's not so likely that you'll have enough cash available to make a 20% down payment. So this is why first-time home buyers will often take out an adjustable rate mortgage. So that's like totally separate loan, and then they give that and say, here's our down payment, so they don't have to pay that mortgage insurance. So it says, as the name implies, the interest rate for an adjustable rate mortgage will change over the life of the loan based on current interest rates. Most ARMs will have a fixed rate for the first 5 years, and then the rate will change based on the market. The rate is often based on the 1-year CMT, constant maturity treasury is what that stands for. So it says, and that rate is based on the yield of 1-year treasury bills. So that's with the federal government. So it says during the past 10 years, the CMT index has ranged from about 1% to 6.3%. In fact, I have a lot of friends who have adjustable rate mortgages and their rates went down. Normally, adjustable rate mortgages, after 5 years, your interest rate goes up and your payments are higher, but because the market is so bad, their payments have actually gone down. So it says the interest rate on an ARM is reset by adding a fixed percent called the margin to the index percent. So if the current value of the CMT index is 3% and the margin set in the loan is 2.5, then the new rate for the adjustable rate mortgage would be 5.5%. And some of them have caps that say it'll never go higher than a certain percent. Okay, so quick, let's look at this problem. Consider a 15-year, $300,000. That's a really big amount for an adjustable rate mortgage, but so 5-1 ARM. So this means the rate is fixed for the first 5 years, and then it's subject to change every 1 year afterwards, having a 2.5% margin based on the CMT index. Suppose that the interest rate is initially 6% and the value of the CMT index is 4.4% 5 years later. And everything's monthly compounding. Okay, so let's look at the payment for the first 5 years. So for 5 years, monthly payments and is $60. For the first 5 years, the interest rate is 6%. The present value is the loan amount. The payment, that's what we're trying to find. Future value is 0, 12. Okay, so payment, alpha, enter. So about $5,800. So it says calculate the unpaid balance at the end of the first 5 years. So if this is a 15-year mortgage, after 5 years, there are 10 years left. So N would be 10 times 12. And we want to find the present value of those 120 payments. That would give us our remaining balance. So go to PV and hit alpha solve. That cannot be right. You can't owe more. What did I do? When I first did this, it was a 15-year mortgage. So I'm sorry. That first one, this shouldn't be 60. This should be 15 times 12. I was just thinking of the first 5 years. So let's quick change that to be 15 times 12. And now find the payment. I was going to say, that's a pretty high payment. Okay, that seems more reasonable. About $25.32. Now find the present value of those 120. Okay, so I'll just change the N to 120 and go to PV, alpha, enter. So 228,027. So that's their balance. That's what they owe starting the 6th year. And then the number of compounding periods that are left are 120, but what's the interest rate now? So the CMT index is 4.4 and the margin is 2.5. So the interest rate will be so here it says the interest rate is just, you just add that. So it would be 6.9. Okay. And so then our new payment is $26.36. So it went up by about $100. And now we can only say that goes for 1 year. That's why they didn't say for the rest of the loan, the 6th year. Because in the 7th year, they look at the CMT index again and they can change your rate again. Okay. All right.